welcome to the Deep Dive. We're your shortcut to feeling, well, truly informed, without getting totally lost in information overload. Today, we're tackling something that, let's be honest, often feels like a dense jungle. All the jargon, the conflicting advice, personal finance and investing. Our mission today is simple. Cut through all that noise, pull out the absolute most important insights, and give you a clear roadmap, something to really empower your financial journey.
Exactly. And for this deep dive, we've pulled from a really wide range of sources. I mean, everything from quite rigorous institutional investment guides to very practical, everyday personal finance blogs, and even some solid academic research.
Okay.
So the idea is to give you a genuinely well-rounded perspective, not just one narrow view on how to get a handle on your money.
Right, comprehensive. Okay, so to really clear the fog, let's start right at the beginning. What exactly is financial literacy? And maybe more importantly, why does it matter so much these days?
Yeah, it's fundamental. At its core, financial literacy isn't just, knowing a few buzzwords. It's really about rewiring your brain for financial success. It's the ability to understand and crucially effectively use different financial skills. We're talking personal financial management, smart budgeting, investing, of course.
Okay.
But it also means really grasping core principles. Things like the time value of money, the idea that $1 today is worth more than $1 tomorrow because it can earn something.
Right, potential growth.
Exactly. And the incredible power of compound interest, knowing how to manage debt effectively, and just general financial planning. What's really fascinating, I think, is the strong link research shows between higher financial literacy and positive financial behaviors.
Like what specifically?
Things like spending less than you earn, proactively setting up an emergency fund, actually opening a retirement account. It's almost like a cheat code for financial peace in modern life, a truly foundational skill.
A cheat code, I like that. Okay, so if that's the big picture, the why, where do we actually start on a practical level? What are those foundational pillars, those building blocks we need?
Good question. For anyone looking to build a really sound financial future, there are basically 6 core pillars to focus on. They are banking, budgeting, saving, credit, debt, and investing.
Okay.
Think of these as the essential components, like the foundation and walls of your financial fortress. They support pretty much every financial decision you'll make through life.
A financial fortress.
Yeah.
Okay, so when we talk about building that fortress, what's the absolute first step, the non-negotiable starting point?
Your primary focus, without a doubt, should be setting up an emergency fund.
Right, the safety net.
Precisely. This isn't just, a nice to have. It is your critical safety net. It's designed purely to cover those unexpected curveballs life throws at you.
Like medical bills, car trouble.
Exactly. Medical bills, car repairs, maybe even a sudden job loss. Experts generally recommend saving at least 3 to 6 months worth of your essential living expenses. Just enough to cover the basics.
3 to 6 months. Okay, how do you actually do that? It sounds like a lot.
The most effective way is usually to save small, manageable amounts, but do it regularly. And here's the key part. Automate it.
Automate.
Yeah, set up automatic transfers. Send that money directly into a separate dedicated account, one that you don't touch for anything other than a real urgent emergency. It's your financial shock absorber. Keep it separate.
Untouchable.
Yeah.
Got it. Okay, so once that emergency cushion is hopefully in place, or at least started, how do we get a handle on the day-to-day money flow? Because that's where I think so many people struggle, right? Even with good intentions.
Absolutely. And that's precisely where budgeting becomes, honestly, your most powerful tool. It sounds simple, maybe even a bit tedious to some, but it's one of the most effective ways to truly control your spending, your saving, and your investing.
So how does it work? Just list everything out.
The first step is simply tracking. You need to know what's coming in your income and what's going out your expenses consistently. There's a very popular framework, quite flexible too, called the 50-30-20 rule. Have you heard of that?
Vaguely, yeah. 50% on needs.
Exactly. The idea is you allocate roughly 50% of your after-tax income to your absolute needs. Rent, mortgage, utilities, groceries, transport.
Okay.
Then 30% goes towards things like dining out, hobbies, entertainment.
The fun stuff.
The fun stuff, yeah. And the remaining 20% is dedicated to savings and paying down debt, especially that high interest debt. What's so useful about this is its flexibility. You can tweak the percentages to fit your situation, but it quickly becomes your secret weapon for spotting where your money might be just vanishing, those little leaks.
Okay, the 50-30-20 rule. That sounds like a practical starting point. Now, let's unravel something that I think trips up so many people but holds huge power.
Yeah.
The world of credit and debt. It's often misunderstood, right? Is all debt just bad? How do we navigate this without falling into traps?
That's a really common question and a super important one. The short answer is no, not all debt is bad. Let's take credit cards, for example. They can actually be incredibly useful tools.
Really? We usually hear horror stories.
Well, yes, there are risks, but think about the convenience. Immediate purchases, right? Plus, they offer interest-free periods, grace periods, sometimes up to 45 days if you pay the balance in full each month. That's the key.
Ah, if you pay it off.
Exactly. And they're also vital for building a positive credit history, which we'll get to in a moment. But you're right, the risks of over-relying on them or carrying a balance are significant. Huge, actually. Consider the statistic, it's pretty sobering. U.S. households collectively owed about $1.17 trillion in credit card debt as of the third quarter of 2024.
Wow, trillion.
Trillion. And the median interest rate, around 24.62% in June 2024. That interest compounds incredibly quickly, digging a very deep, very unforgiving hole if you're not careful. So to really understand it, we need to distinguish between good debt and bad debt.
Okay, break that down. What's the difference?
Good debt is generally seen as an investment in your future, something intended to increase your quality of life or your net worth over time. And it usually comes with lower interest rates.
Like a mortgage? Or a student loan, maybe?
Potentially, yes. A well-researched mortgage on a home that appreciates, maybe a business loan to start something viable. Student loans can be, though the value depends on the career outcome, of course. Bad debt, on the other hand, actively works against you. It's like a financial anchor, just dragging you down, eroding your stability.
So credit card debt carried month to month.
Definitely high on the list, especially credit card debt on things that don't build wealth consumables, vacations you can't afford. Also, things like payday loans are notoriously bad debt. Their APRs, the annual percentage rates, can be astronomical, 300, even 800%.
Ouch. Okay. So priority number one is tackling that bad debt.
Absolutely. It's crucial to prioritize repaying bad debt. There are different strategies people use. You might hear about the high rate approach that's tackling the debts with the highest interest rates first. Saves you the most money on interest.
Makes sense mathematically.
It does. Or there's the snowball effect. That's where you pay off the smallest debts first, regardless of the interest rate.
Why would you do that?
It's more about psychology.
Yeah.
Getting those quick wins, knocking out a whole debt, can give you momentum and motivation to keep going. It feels good.
Okay. That distinction between good and bad debt is really crucial. But, for someone maybe grappling with high credit card debt, it often feels like this inescapable trap. Beyond just distinguishing, what's the emotional hurdle there? How do we kind of support listeners feeling that overwhelmed?
That's a fantastic point. The emotional weight is huge. There's often shame, feeling overwhelmed, feeling stuck, feeling like a failure even. These are powerful emotions, and that's why strategies like the snowball method can be so effective. It's often as much about the psychological wins as it is about the pure financial math. Seeing those balances actually disappear one by one, even small ones, can create the motivation, that sense of agency needed to keep pushing forward. It helps shift the mindset from, I'm completely buried, to, okay, I can actually do this.
That makes perfect sense. Dealing with the feeling as much as the numbers. Okay.
Yeah.
So thinking about lenders, banks, how do they gauge our financial trustworthiness? What's the score, literally?
Right. That's where your credit history and your credit score become incredibly important. Your credit history is basically the detailed record of how you've managed money and debt in the past. Do you pay your bills on time? How much credit do you use compared to your limit? All that stuff.
That affects, everything. Right.
Pretty much. It impacts your ability to get loans, obviously, but also sometimes jobs, renting an apartment, even getting insurance. And it directly influences the interest rates you'll pay. Better history, lower rates.
Okay. And the credit score, that's the number.
Exactly. The credit score is usually a 3-digit number, typically between 300 and 850. It's essentially a snapshot prediction of how likely you are to repay a loan based on your history. Higher score, less risk for the lender.
So how do we check this? Keep an eye on it.
Good news here. You can actually get free weekly credit reports from each of the 3 main nationwide credit bureaus. That's Equifax, Experian, and TransUnion.
Weekly. Free.
Yep, via the official site, annualcreditreport.com. Plus, Equifax is offering an additional 6 free reports annually through 2026. So there's really no excuse not to monitor them.
Why monitor so often?
It's smart practice. Check for any errors they happen or signs of identity theft. Catching those early is crucial.
Okay, solid advice. So we've laid the groundwork, safety net, budgeting, understanding debt, and credit. Now for the exciting part, making your money actively work for you, turning it from just sitting there into a wealth builder. What's the fundamental principle here, the thing that really drives long-term wealth? Almost like, well, magic.
You're talking about compound interest. And yeah, it feels like magic sometimes, but it's pure math working in your favor over time. It's often called the eighth wonder of the world.
Okay, explain the magic or the math.
Basically, it's interest earning interest. Your initial investment earns a return, and then that return starts earning its own return, and so on. It snowballs. There was a great example in our sources comparing two people, Miguel and Jasmine. Miguel actually contributed less money overall to his investments than Jasmine did.
Okay.
But, and this is the crucial part, he started investing much earlier. Because his money had more time to grow, those initial investments, compounded year after year, significantly boosted his final nest egg. It grew far beyond Jasmine's, even though she put in more cash later on.
Time is the key ingredient then.
Time is the accelerator. It dramatically illustrates how even relatively small, consistent investments, just given enough time, can lead to really substantial, sometimes even astounding growth. And this isn't just for stocks. Savings accounts, certificates of deposit, CDs, retirement accounts like 401ks and IRAs, even standard brokerage accounts. These are all places where compound interest can work for you.
That Miguel and Jasmine example really drives home the power of starting early.
Yeah.
Wow. Okay, so what does this mean for someone who's ready to actually invest their money? What are the broad categories? And how should we think about the risk involved versus the potential returns?
Right. When you start diving into investing, you'll generally find things fall into three major categories, mostly based on that risk and return profile. First, you've got your low risk, low return options. Think money market accounts, treasury bills, CDs, maybe some types of bonds.
Safe, but probably not going to make you rich.
Pretty much. The main idea here is capital preservation. Storing money safely, having easy access, very low risk of losing your initial amount. You hope for a little growth, maybe beat inflation, but the primary goal is safety. Then you move up the ladder to moderate risk, moderate return investments.
Okay, what's in this bucket?
This is where you primarily find things like mutual funds and index funds. A really common example people talk about is the S&P 500 index.
Right, the big 500 U.S. companies.
Exactly. It's often seen as kind of a benchmark for the U.S. economy. Investing in an S&P 500 index fund gives you broad exposure to the market. Historically, its average annual return has been around 10% over the long term, maybe 6-7% after you account for inflation. More risk than a CD, but more potential return.
Okay, and the third category, high risk.
Yep. High risk, high return options. This is where you find things like investing in single, individual stocks, cryptocurrencies, commodities like oil or gold.
Higher potential payoff, but also...
Yeah, higher potential loss. Much higher. The general philosophy across all of this is crystal clear. Investors need to understand the amount of risk they're taking on and weigh it against the potential reward or the potential loss. It's the fundamental trade-off in investing.
That makes sense. Risk versus reward. Okay, so given those different risk levels, it immediately brings up a really crucial question.
Yeah.
How do we spread that risk out? We always hear that old saying, don't put all your eggs in one basket. What does that actually look like for an investor?
That old saying points directly to diversification. And yes, it is absolutely a critical risk management tool. It's fundamental. It simply means allocating your investments across various categories. Different asset classes like stocks, bonds, maybe real estate or alternatives, different industries, tech, healthcare, energy, consumer goods, different companies within those industries, and even different countries.
Why spread it so wide?
Because the best performing asset class, industry, or even country changes constantly. It's incredibly difficult, maybe impossible, to predict consistently who's going to be the winner next year or the year after. In fact, our sources specifically cautioned against something called home country bias.
What's that? Investing too much close to home.
Exactly. Investors naturally tend to overinvest in their own country's markets, the companies they know, but that can actually hurt your results if your home market underperforms the global market.
Okay, so diversification smooths things out.
It helps manage risk. And interestingly, decades of research, including some really landmark studies, consistently show something fascinating. It's how you divide up your investments, your asset allocation, that mix of stocks, bonds, cash, etc., that often has a bigger impact on your long-term returns than trying to pick the absolute best individual stock or time the market perfectly.
Wow, okay. So the big picture mix matters more than the individual picks, generally speaking.
For most long-term investors, yes, asset allocation is widely considered the key driver of performance. That's actually quite empowering. It feels less like you need to be a stock-picking genius. But even with the diversification, markets go up, markets go down, sometimes wildly. How should we approach that inevitable volatility, those stomach-churning drops?
Yeah, it's vital to just accept that volatility happens. It's not an if, it's a when. Market swings, ups and downs are an inescapable part of investing. And reacting emotionally, especially panic selling when things dip, can be absolutely detrimental to your long-term success. History shows this very clearly.
How so?
Well, despite those periods of volatility, sometimes scary ones, markets have consistently historically recovered and eventually reached new highs. Let me give you a really compelling statistic from the S&P 500 data we looked at. Imagine a hypothetical $10,000 investment made back in 1979 and held through 2022. If you stayed fully invested the entire time through all the ups and downs,
Okay.
it could have grown to around $758,000.
Wow, that's significant growth. It is. But here's the kicker. If you panicked and missed just the 5 best days in the market during that entire period, maybe you sold low and bought back higher.
Just 5 days.
Just 5 single days, your final amount could have dropped dramatically, down to $470,000. You'd have lost almost $500,000 in potential gains just by missing those few key recovery days.
Oh my goodness. And if you missed more.
If you missed the 50 best days over those decades, your $10,000 would have only grown to about $53,000.
That's staggering. It really shows the cost of trying to time it or reacting emotionally.
Exactly. It highlights just how crucial it is to stay invested, stay the course, even when things feel rocky. Ride out the dips if your long-term plan is sound. And this actually ties into another core principle: buy low, sell high.
The classic advice. Easier said than done, though, right?
It is, psychologically. But those short-term market dips, when everyone else is panicking, they can actually represent buying opportunities for investors with a long-term view and available cash. Some approaches even involve a dynamic element to portfolio management, making calculated short-term tactical adjustments within certain guidelines, perhaps buying more when prices are low. This can potentially add value compared to just a completely static, unchanging allocation. It's about being prepared and maybe a little contrarian when others are fearful.
Being greedy when others are fearful, as they say. Okay, so with all that theory in mind, compounding, risk, diversification, volatility, what are some of the specific investment strategies people actually use? The practical approaches to navigate these markets and work towards their goals.
Right. Let's look at some common strategies. First, there's passive index investing.
Like the S&P 500 funds we mentioned.
Exactly. This is often ideal for long-term investors, like people saving for retirement. It's essentially a buy and hold approach. You buy a broad market index fund and just hold it. The idea is to ride out those short-term fluctuations, capture the market's average return, and really benefit from long-term compound growth. Plus, these funds usually have much lower fees than actively managed ones.
Simple, low cost, long term. Got it. What else?
Next up is value investing. This is the strategy often associated with people like Warren Buffett. It focuses on finding companies whose stock prices appear to be trading for less than their true underlying intrinsic value. You're looking for bargains, essentially.
So searching for diamonds in the rough.
Kind of, yeah. Looking for solid companies that the market might be temporarily undervaluing. It offers potential for large gains if the market eventually recognizes that value. Also, value companies are often more established and more likely to pay dividends.
Okay. Value investing. What's the opposite, maybe?
That would likely be growth investing. This strategy targets companies, often smaller or younger, that are expected to grow their earnings at a much faster rate than the overall market.
High potential, high speed.
High potential, yes, but also inherently riskier. These companies might be reinvesting everything back into the business, so they typically don't pay dividends. Growth investing tends to do better in certain economic climates, maybe when interest rates are falling.
Riskier, maybe no dividends, potential for faster growth. Okay. Any others?
There's also momentum investing. This is quite different. It involves buying stocks that are already experiencing a strong upward price trend.
Buying high and hoping it goes higher.
Essentially, yes. And potentially short-selling stocks that are in a clear downtrend. It relies heavily on technical analysis, looking at charts and patterns rather than the company's fundamental value.
Sounds exciting, maybe.
It can be because of the quick price action, but it's definitely high risk, high reward. It requires significant skill and discipline to gauge the right entry and exit points. You can lose money very quickly, and you'll likely face short-term capital gains taxes. Not for the faint of heart.
Definitely not buy and hold. Okay, one more.
A very practical one for many people is dollar cost averaging, or DCA.
How does that work?
It's a disciplined approach where you invest a fixed amount of money at regular intervals, say every month or every paycheck, regardless of what the market is doing, like automatic deductions into a 401k.
So you buy whether the market is up or down.
Exactly. And the magic is when prices are low, your fixed dollar amount buys more shares. When prices are high, it buys fewer shares. Over time, this can lower your average cost per share.
It smooths out the bumps.
Precisely. DCA is highly effective because it takes the guesswork and emotion out of trying to time the market. It counteracts those common human biases we have, like fear of loss or chasing hot stocks. The main requirement is simply having that regular cash flow to invest consistently.
Okay, those are some distinct strategies. But beyond those broad approaches, are there ways to fine-tune? Like specific ways to select investments that really align with particular goals, like needing income versus wanting maximum growth.
Yes, absolutely. Research has identified certain characteristics or investment factors that can help investors tailor their portfolios to meet specific goals.
Factors, like what?
Things like high quality focusing on companies with strong balance sheets, stable earnings, good management, dividend yield looking for companies that consistently pay out a portion of their profits to shareholders as dividends.
Okay.
Low volatility, choosing investments that tend to have smoother price movements, less dramatic ups and downs. Value, which we talked about, finding undervalued companies. And small size investing in smaller companies that may have greater growth potential than large established ones. Over long periods, these factors have often demonstrated outperformance compared to the broader market, sometimes with less risk.
So how would someone use these?
Well, for example, if you're an investor primarily seeking regular income, maybe in retirement, you might tilt your portfolio towards investments with a high dividend yield or maybe low volatility bonds.
Thanks, Zach.
If your main goal is long-term growth and you have a higher risk tolerance, you might lean more towards smaller companies or those exhibiting strong value characteristics. It's about deliberately choosing investments whose underlying traits align with your personal financial objective.
Tailoring the portfolio using these factors. Interesting. Okay, this has been incredibly comprehensive. We've covered so much ground. Now, with all this powerful information, all this potential for growth, let's talk about the other side. What are the most common financial pitfalls, the investing mistakes we should really actively watch out for and try to avoid? What are those major tripwires?
Yeah, it's crucial to know the common mistakes because they can really derail even the best intentions. And honestly, a lot of them come down to human psychology. One of the biggest, and this echoes advice from famous investors like Warren Buffett, is simply not understanding the investment you're putting your money into. If you can't explain it simply, you probably shouldn't own it.
If it sounds too complicated.
It might be. Another huge one is trying to time the market. Buying and selling based purely on emotion, that fear when markets drop or greed when they soar. We saw the data on how damaging missing just a few key days can be.
Right, the 758K versus 53K example. Ouch.
Exactly. Another classic mistake. Putting all your money into one single stock or investment. That's the opposite of diversification, and it's incredibly risky. If that one thing goes bad, you're sunk.
All eggs, one fragile basket.
Precisely. Also, be vigilant about ignoring fees or account costs. They might seem small, maybe 1% or 2% a year, but over decades, those fees compound too and can quietly eat away a huge chunk of your returns. Very. And perhaps most fundamentally, not having a long-term plan. Just investing randomly without clear goals or a strategy is a recipe for making emotional decisions. Often, the number one killer of investment returns isn't the market itself, it's the investor's own emotions. Patient investors who stick to their plan typically achieve much better long-term results.
So, avoid panic selling, avoid chasing fads.
Yes. And related to that, avoid the cognitive error of waiting to get even on a losing investment. Thinking, I'll sell it once it gets back to what I paid for it.
Refusing to admit a mistake.
Basically. Holding on to a loser, hoping it recovers, can lead to even further losses and, just as importantly, ties up money that could be working harder for you elsewhere. That's opportunity cost. Sometimes you just have to cut your losses and move on. And beyond just investing, there are broader financial mistakes we see all the time.
Like what? Day-to-day stuff?
Yeah. Overspending is probably the biggest. It doesn't matter how much you earn. If you consistently spend more than you make, you'll never build wealth. It just creates a debt cycle and drains potential savings. Closely linked is not having that emergency fund we talked about earlier. When a crisis hits, and it will, without that cushion, You're forced to rely on high-interest debt like credit cards or loans, making a bad situation worse.
Setting yourself back further.
Exactly. And relying too much on credit cards generally, carrying balances month after month. That high interest works against you, compounding your debt rapidly. Then there are two critical mistakes that really impact your future security. First, simply not investing for retirement. If your money just sits in cash, inflation erodes its purchasing power over time. Plus, you completely miss out on the power of compounding growth over decades.
Leaving huge potential gains on the total.
Huge. And the second one, which might surprise some people, is paying off debt by raiding your retirement savings.
Pulling money out of a 401k to pay off a credit card.
For example, yes, it might seem like a quick fix, but it can be incredibly damaging. You halt the power of compounding on that money. You might face hefty early withdrawal penalties and taxes. And studies show people who do this often end up back in debt anyway because they haven't fixed the underlying spending habits. It's usually a last resort.
Wow, those are really vital warnings. Lots of potential pitfalls. Okay, so to bring this all home for everyone listening, what are the absolute key personal finance skills we can cultivate? The habits we can build to create a successful financial future, whether we're just starting out or maybe looking to optimize things?
Sure, if we distill it down, there are maybe three crucial personal finance skills that act as cornerstones for success. First is financial prioritization. This is the ability to consistently focus your time, energy, and money on the things that ensure money keeps flowing in and gets allocated where it makes the most positive impact towards your goals, knowing what matters most.
Okay, focus. What's second?
Second is assessing costs and benefits effectively. Before jumping into a new venture, a big purchase, or taking on debt, really think through the potential upsides and downsides. Make informed decisions. This helps prevent spreading your resources too thin or making costly mistakes.
Thinking before leaping.
Exactly. And third, maybe the most fundamental discipline is restraining spending. This is absolutely critical. As we said, you can earn a fantastic income, but you simply won't build wealth if you consistently spend more than you make, especially on things that don't appreciate or generate income. It boils down to consistently meeting your monthly savings or debt reduction goals before you spend on discretionary items or non-wealth building assets. Pay yourself first, as they say.
Prioritize, assess, restrain. That seems like a solid foundation.
It is. And while there are lots of helpful rules of thumb in personal finance, like save 15% for retirement or always invest for the long term, it's also really important to understand your own unique circumstances.
Rules aren't always one size fits all.
Not always. For instance, if you have cripplingly high interest credit card debt, aggressively paying that down might actually be a better immediate priority than maximizing retirement contributions because the interest saved is like a guaranteed high return.
Right, that makes sense.
Or maybe for someone younger, strategically using some funds for experiences or education that could enhance future earning potential might offer a different kind of valuable return, one that aligns better with their current life goals than just purely maximizing savings. It's about being strategic and informed, not just blindly following rigid rules.
Understanding the why behind the advice and adapting it. Got it. Well, we have certainly covered a lot in this deep dive, from those absolute fundamentals of financial literacy and setting up that crucial safety net, to really understanding the, well, almost magical power of compounding, exploring different ways to invest your money, different strategies, and importantly, identifying those critical mistakes to actively avoid. We've really tried to lay out the blueprint for building that financial fortress.
Yeah, and our goal throughout this deep dive was really just to equip you, the listener, with the core insights you need to feel more confident, to feel empowered to make informed financial decisions for yourself, turning what can often feel like really complex, overwhelming information into clear, actionable knowledge.
So let's end with this thought. Remember that old adage, often repeated because it's true. The best time to invest was yesterday. The second best time is today. Thinking about everything we've discussed was one small, consistent step you can take toward your financial goals, starting right now. How can you begin to harness that power of compounding and build a more secure financial future for yourself? Something to think about. Thank you so much for joining us on this deep dive.